Let me ask you a question. What's your single most valuable financial asset? Is it your house, your car, your investments? Well, for most of us, it's actually our ability to earn an income. And today, we're going to talk about how to protect it. Let's dive right into our buyer's guide for disability insurance.
Here's the game plan. First, we'll talk about why you should even care about this stuff. Then, we'll break down what actually makes up a policy. After that, we'll get into pricing, how you can customize your coverage, and we'll wrap up with the absolute most important things to remember. So, first things first, let's get right to the heart of it. Why does this type of insurance even matter in the first place?
I want you to just think about this for a second. Seriously, what if, tomorrow, your income just stopped? An unexpected illness, a sudden injury, and poof, it's gone. How do you pay the mortgage? How do you cover the bills or buy groceries? This is the exact problem disability insurance was invented to solve.
The best way to think about it is as your own personal income safety net. It's a promise, an insurance contract, that says if you can't work, we'll send you a monthly check to help replace that lost income. And what's so critical here is that this is 24/7 coverage. It doesn't matter if you get hurt skiing on vacation or at your desk on a Tuesday, you're covered.
Okay, so now we know why it's so important. Let's pop the hood and see how it actually works. We're going to look at the anatomy of a policy, the essential building blocks that every single one is made of. Look, every single disability policy out there, no matter how complicated it might seem, boils down to these three things. These are the three main levers. If you can get your head around these pillars, you'll understand how any policy works. They basically answer three questions. How long do I get paid? How much do I get paid? And how soon do the payments start?
First up, the benefit period. This is simply the maximum amount of time you can get paid for any one disability. You've got short-term options, which might last a couple of years, and then you have long-term plans that could potentially pay you all the way until you retire. Now, obviously, a longer benefit period gives you way more security, but it's a classic trade-off. It's also going to cost more.
Next is the elimination period. This is a really clever concept. The easiest way to think about it is like the deductible on your car insurance, but instead of being about money, it's about time. It's the number of days you have to be out of work before your benefits actually kick in. And just like with your car insurance, if you're willing to take on a longer waiting period, say 90 days instead of 30, you're going to see a lower premium.
Now, this slide clears up something that confuses a lot of people: the difference between an elimination period and a probationary period. Your elimination period, that time-based deductible we just talked about, that applies every single time you make a claim. But the probationary period, that only happens once, right at the very beginning of a policy. It's basically the insurance company's way of making sure you're not buying a policy because you already know you're about to get sick.
So let's talk about the money. How much would you actually get paid each month? Well, there are usually two ways insurers figure this out. On the right, you'll see the percent of earnings approach. That's really common for group plans you might get through your job. But for the individual policies we're focusing on today, you'll almost always see what's on the left, the flat amount method. That means your benefit is a specific, fixed dollar amount, say $1,800 a month, that gets locked in the day you buy the policy.
Let's put all this together with a quick story. Meet George. His policy gives him an $800 a month benefit and has a 30-day elimination period. Sadly, George gets disabled and is out of work for 90 days. So for those first 30 days, that's his time deductible, he gets nothing. But then for the remaining 60 days, which is 2 months, the policy starts paying him. So you take 2 months times his $800 benefit, and you get a total payout of $1,600. See? Pretty straightforward when you break it down. Okay, we've got the basic structure down. So let's move on to the big question everyone always has. What does this stuff actually cost? What factors go into deciding your premium?
The price really boils down to two buckets of information. The first bucket is about your choices, the things you control, like how much benefit you want, for how long, and how long you're willing to wait for it. The second bucket is all about your personal profile, your age, your gender, your health history. But there's one other factor that people often forget about, and it is a huge one: your job.
And this chart shows you why your occupation is so critical. Insurers look at something they call morbidity risk, which is really just a fancy way of saying, what are the odds of you getting sick or hurt based on what you do for a living? As you can imagine, a job the desk sits down has a much lower risk than a job that's physically demanding. And that difference in risk is going to show up directly in your premium. All right, now for the really cool part. A basic policy is one thing, but you can actually tailor it to fit your exact needs using these optional add-ons called riders. You can think of them like upgrades or special features for your policy. So let's look at a really common problem. You're smart, you buy a policy today based on what you're earning. But what happens in 5 or 10 years? You've gotten a couple of promotions, your salary is way higher, but your disability benefit is still stuck back in the past. It's too low now.
The solution is this: the Guaranteed Insurability Rider. This is an incredibly powerful feature. It gives you the right to buy more coverage in the future as your income goes up, and, this is the key part, you don't have to prove you're still healthy. No new medical exams. The only catch is you usually have to use this option at specific times, like on your policy anniversary. If you skip it, you might lose that chance for good.
Okay, here's another problem, but this one is more of a long-term threat. Imagine you're on a claim for, say, 15 years. That fixed monthly benefit that seemed great back when you bought the policy? Well, thanks to inflation, it just doesn't buy as much anymore. Its purchasing power slowly gets eaten away.
And the answer to that problem is a Cost of Living Adjustment Rider, or COLA for short. This rider is built specifically for long-term claims. Once your benefits start, it will automatically increase your monthly payout each year, typically tied to an inflation measure like the Consumer Price Index. It's designed to make sure your benefit keeps up with the rising cost of everything else.
And believe me, there are plenty of other ways to customize. There are riders that can help fill the gap if you get denied for Social Security. There's even a rider that can give you some of your money back if you never make a claim. You can add lump sum payouts for major accidents or even get extra daily cash if you end up in the hospital. The options are all there.
Wow, okay, we have covered a ton of ground. So for this last section, let's just boil it all down. What are the absolute most crucial takeaways you need to remember from all of this?
This is one of the most important things to look for in a policy. Is it guaranteed renewable or non-cancelable? Now, they both sound pretty similar, right? And in one way, they are. With both, the insurance company can never cancel your policy as long as you pay the premiums. But there is one giant difference: the price. Guaranteed renewable means they can raise your rates in the future, but only if they do it for everyone in your group. Non-cancelable, on the other hand, means your rate is locked in forever. It's more expensive for sure, but it gives you total peace of mind on the cost.
You know, it's also really helpful to just understand where the insurance company is coming from. This whole application process, what they call underwriting, it's really all about two things. First, protecting against adverse selection, which is just making sure people aren't buying fire insurance when their house is already smoking. And second, it's to properly classify your unique risk so they can charge you a fair price for it.
And that really brings us full circle. We spend so much time and energy insuring our homes, our cars, and our lives. So we'll just leave you with this one last question to think about. Is your most valuable financial asset, that incredible ability you have to earn an income year after year, is it protected? Thanks so much for watching.